Have you ever felt completely paralyzed watching your stocks go absolutely nowhere? Day after day, week after week, you stare at your screen, seeing the same frustrating horizontal movement, wondering if you should just close your positions and walk away until something finally happens. What if I told you that while you're sitting there frustrated, professional traders are quietly extracting consistent profits from these exact same sideways markets that everyone else considers dead zones? Most traders treat sideways markets like a cruel punishment from the trading gods, a boring wasteland where their capital sits trapped, earning nothing while they wait impatiently for the real moves to begin. They've been conditioned to believe that money is only made during explosive trends, massive breakouts, or dramatic crashes. But here's the truth that might completely transform your trading approach. Some of the most reliable, consistent, and mathematically predictable profits in the market come from these supposedly dead periods that everyone else is ignoring. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Has this ever happened to you? You analyze a stock thoroughly, see what looks like a perfect setup, enter your position with confidence, and then nothing. The stock just oscillates back and forth in this maddening range, refusing to break out in either direction. Your excitement turns to boredom, then frustration, and eventually you exit the position right before it finally makes the move you were waiting for. Sound familiar? The revelation that changes everything is understanding that these sideways markets aren't obstacles to avoid. They're opportunities disguised as inconveniences. While the crowd waits impatiently for volatility, the informed trader recognizes that range-bound conditions actually offer something that trending markets rarely provide: clearly defined boundaries that act as profit zones with predetermined risk parameters. What separates the professionals from the amateurs isn't access to better information or more sophisticated software. It's a fundamental shift in perspective about what constitutes a trading opportunity. The amateur needs excitement, needs movement, needs the adrenaline rush of catching explosive moves. The professional understands that consistent profits come from exploiting predictable patterns. And nothing is more predictable than a stock that repeatedly bounces between well-established support and resistance levels. Stay with me until the end, because what you're about to discover might completely change how you view consolidation periods. The setup we're going to explore doesn't require complex indicators, expensive subscriptions, or hours of analysis. It's built on principles that have worked for over a century, adapted specifically for the conditions that frustrate most traders into inaction. The beautiful irony is that while everyone else sits on the sidelines complaining about choppy markets and waiting for clearer direction, these sideways patterns are literally drawing roadmaps showing you exactly where to enter, where to exit, and where to place your stops. The market is handing you a blueprint, and most traders are too impatient to recognize it. The transformation in your trading journey begins the moment you realize that the market is constantly communicating with you through the most honest language it knows: price action itself. Think about it for a moment. Every single day, stocks are literally drawing boundaries on your charts, showing you exactly where buyers step in with conviction and where sellers take control. These aren't random movements or chaotic fluctuations. They're patterns of human behavior repeating themselves with remarkable consistency, and they're spelling out your profit zones in plain sight. Most traders completely miss this revelation because they're too busy chasing the next hot tip, subscribing to expensive newsletters, or following some guru's predictions on social media. They want someone to tell them what's going to happen next, as if the future can be predicted with certainty. But here's the hidden truth that changes everything. You don't need to predict the future when the market is showing you its present behavior so clearly. When a stock bounces off the same support level 3, 4, 5 times, that's not coincidence. That's a clear message about where value buyers believe the stock is worth owning. When it repeatedly gets rejected at the same resistance zone, sellers are telling you exactly where they think it's overpriced. This is the mindset shift that separates those who consistently extract profits from sideways markets and those who sit frustrated on the sidelines. The amateur trader sees a stock oscillating between, let's say, $42 and $48 and thinks, "This is going nowhere, I'll wait for a breakout." The professional trader sees that exact same pattern and recognizes a clearly defined profit zone with a $6 range where they can systematically buy near support and sell near resistance over and over again, while the amateur waits for something better. If this resonated with you, hit subscribe. I create content that explores the psychology and discipline behind consistent trading success. The journey into understanding range-bound conditions requires you to embrace a simple principle that sounds almost too obvious to be valuable. A stock trading sideways will continue trading sideways until it decisively proves otherwise. This is its line of least resistance during consolidation phases. When you witness a stock attempting to break above resistance multiple times, but getting pushed back down, or trying to breach support but bouncing right back up, the market is essentially drawing a box around the price action and saying, "I'm comfortable here, I'm not ready to move yet." That's not a problem to solve. It's an opportunity to exploit. Behind the scenes of every successful range trader is this fundamental decision to stop fighting what the market is doing and start respecting it instead. They're not trying to predict when the breakout will happen or which direction it will go. They're simply acknowledging that right now, in this moment, the stock has established boundaries, and those boundaries represent their playing field. The impact of this perspective shift cannot be overstated. It removes the anxiety of prediction and replaces it with the clarity of observation. Now, I want to go even deeper into this topic and explore exactly how you identify when a range is genuinely reliable versus when it's about to break, because understanding this distinction is where the real edge emerges. The subtle clues that separate a tradable consolidation from a pre-breakout setup are hiding in the price action itself. And once you know what to look for, you'll never view sideways markets the same way again. If this approach to reading market behavior resonates with you, write "Price tells the truth" in the comments below. The uncomfortable truth that most traders never want to face is that simplicity places all responsibility squarely on your shoulders. And there's something deeply challenging about that level of accountability. When you're following a complex system with 17 indicators, Fibonacci retracements, Elliott wave counts, and algorithmic signals, you always have something to blame when things go wrong. The system failed, you can tell yourself. The indicators gave a false signal. But when your approach is as straightforward as buying near support and selling near resistance in a clearly defined range, there's nowhere to hide from. The reality of your own execution, or lack thereof. This revelation about self-responsibility represents one of the most transformative aspects of mastering sideways markets. The market essentially becomes a mirror reflecting back your true character, your discipline, your patience, your ability to follow through on your own rules even when it's uncomfortable. You can see the pattern clearly. You know the stock has bounced off $42 5 times. You know it's approaching that level again. And yet, when the moment arrives to actually execute the trade, something inside you hesitates. Maybe it's fear that this time will be different. Maybe it's doubt creeping in from past losses. Maybe it's just the paralysis that comes from knowing the decision is entirely yours. Behind the scenes of every consistently profitable range trader is someone who has fought and won this internal battle countless times. They've developed what I call execution discipline, the ability to act on their rules without emotional interference. This isn't about being emotionless or robotic. It's about recognizing that the hardest part of trading isn't the analysis or the pattern recognition. It's the gap between knowing what you should do and actually doing it when real money is on the line. Think about how this dynamic plays out in your own trading journey. How many times have you identified a perfect setup, told yourself exactly what you should do, and then either hesitated at the critical moment or acted impulsively at the wrong time? The pattern was clear, the opportunity was obvious, but something in your psychology sabotaged the execution. This isn't a character flaw, it's simply the human condition. Fear and doubt are hardwired into us as survival mechanisms, and they don't distinguish between real physical danger and the psychological discomfort of risking capital. The impact of developing true discipline in range trading extends far beyond your trading account. You're essentially training yourself to trust your own judgment, to act on your convictions despite uncertainty, and to maintain consistency even when your emotions are screaming at you to deviate from your plan. These are life skills that transfer into every decision you make, every goal you pursue, every challenge you face. The market becomes your training ground for self-mastery. What makes sideways markets particularly powerful for developing this discipline is that they give you repeated opportunities to practice. Unlike a trend that might last months with only 1 or 2 entry points, a range offers you the same setup over and over again. Each time price approaches support, you face the same decision. Each time it nears resistance, you're presented with the same choice. This repetition is either your greatest teacher or your most persistent tormentor, depending on whether you're learning from each instance or repeating the same mistakes. Now, I want to go even deeper into understanding why. Patience, real patience, not just waiting but strategic inaction, becomes your most valuable asset in these consolidation zones, and how it fundamentally changes your relationship with market timing. If you've recognized this internal struggle between knowing what to do and actually executing, type "discipline is my edge" in the comments. The hardest lesson for most traders to internalize is that in range-bound markets, your most profitable action is often doing absolutely nothing. This goes against every instinct we have about productivity and engagement. We live in a culture that celebrates constant activity, that equates busyness with effectiveness. But the market doesn't reward you for being busy. It rewards you for being right at the right time. And sometimes the right time means waiting days for price to actually reach the extremes of your identified range before taking any action whatsoever. Think about the psychological challenge this presents. You've identified a beautiful range between $42 and $48. The stock is currently trading at $45. You know where you want to buy, you know where you want to sell, but right now, in this moment, your optimal move is to wait. Do nothing, just watch. For amateur traders, this waiting period becomes unbearable. They start rationalizing reasons to enter now. Well, 45 is closer to support than resistance, so it's kind of a good entry. Maybe I'll just take a small position now and add more if it goes lower. This is how discipline erodes and edges disappear. The hidden truth behind every consistently profitable range trader is their ability to sit on their hands through these tempting middle zone periods. They understand that buying at 45 when support is at 42 means they're risking $3 to potentially make $3 if it reaches resistance at 48. That's a 1-to-1 risk-reward ratio, which is mediocre at best. But if they wait patiently for price to actually touch 42, they're now risking perhaps $1 with a stop just below support to make $6 as it travels to resistance. That's a 6-to-1 ratio, and that mathematical edge is what creates sustainable profits over time. Behind the scenes of blown trading accounts are traders who couldn't tolerate this waiting period. They chase every little wiggle inside the range, racking up transaction costs and getting chopped up by normal price fluctuations. They enter too early, exit too early, re-enter at worse prices, and slowly bleed their capital through death by 1,000 cuts. The professional, meanwhile, might only take 2 or 3 trades while the amateur is taking 20, yet the professional's returns are dramatically higher because each trade is executed at optimal levels with superior risk-reward. This journey into patience reveals something profound about decision-making under uncertainty. The market is constantly tempting you to act, constantly presenting what looks like opportunities. Learning to distinguish between real opportunities at the range extremes and fake opportunities in the middle zone becomes a skill that transforms not just your trading, but your entire approach to recognizing when action is warranted and when patience serves you better. But here's where the discipline that makes you successful in ranges also protects you when market conditions inevitably change. The same rules that tell you to trade the boundaries must also tell you when to stop trading the range entirely. When a stock that has been reliably bouncing between 42 and 48 suddenly breaks through 48 with strong volume and conviction, your job isn't to fight it or to short it at 49 because you're comfortable with the old range. Your job is to recognize that the market structure has changed and the playbook must change with it. Now I want to go even deeper into understanding the specific signals that tell you a range is about to break versus when it's likely to continue, because this distinction is where most traders lose their entire profits from successfully trading the range. If waiting for optimal setups has been your biggest challenge, comment "Patience is my superpower" below. One of the most overlooked advantages of trading sideways markets is how they fundamentally change your approach to position sizing, and this shift can have a dramatic impact on your overall returns. When you're trading trends, your risk is often undefined or at least somewhat ambiguous. Where exactly should you place your stop? How far might a pullback go before the trend resumes? These questions create uncertainty that forces conservative position sizing. But in a well-defined range, your risk is crystal clear from the moment you enter the trade. Think about the transformation this creates in your decision-making process. If you're buying a stock at $42 with support clearly established at that level, you know with near certainty that your stop should be placed just below, perhaps at $41.50 or $41. Your maximum risk is predetermined. It's 50 cents to $1 per share. This clarity allows you to size your position more aggressively because you're not guessing about potential downside. You're calculating it precisely based on observable market structure. If you found value here, drop a like so other traders can discover these principles too. It helps more than you know. The hidden truth here is that most traders actually do the opposite of what they should. They size up aggressively in trending markets where risk is less defined, and they trade timidly in ranges where risk is perfectly clear. This backwards approach comes from a fundamental misunderstanding of where your edge actually lies. In ranges, you have multiple advantages stacked in your favor: clear entry zones, defined exit targets, predetermined risk levels, and predictable price behavior. These conditions should give you the confidence to maximize your position size within your risk management parameters. Behind the scenes of successful range traders is a mathematical framework that makes their approach almost inevitable over time. The beauty of this setup lies in its elegantly simple arithmetic. When you consistently buy near support and sell near resistance in a range, you're typically risking 2% of your position to potentially gain 4 to 6% as price traverses from one boundary to the other. Let's break down what this means for your account over time. If you're right just 50% of the time, which is a coin flip, nothing special, but your average winner makes you 5%, while your average loser costs you 2%, the math works overwhelmingly in your favor. 10 trades with 5 winners and 5 losers means you make 25% on your winners and lose 10% on your losers, netting you a 15% gain. And this is assuming you're only right half the time. Many well-executed range strategies see win rates of 60 or even 70% because the boundaries are so clearly defined. This revelation about the mathematics transforms how you think about success in trading. You don't need to be some market genius who's right 80 or 90% of the time. You simply need the discipline to execute your trades at the optimal zones, buying near support, selling near resistance, and cutting losses. Immediately if the range breaks, the numbers do the rest of the work for you. The journey from struggling trader to consistent profitability often isn't about finding better setups or more sophisticated analysis. It's about recognizing these mathematically advantageous situations and having the discipline to exploit them repeatedly. Now, I want to go even deeper into the psychological barriers that prevent traders from actually executing this mathematically sound approach. Because understanding your own resistance to following simple, profitable rules is where the real transformation happens. If the mathematical edge of range trading resonates with you, write "numbers don't lie" in the comments. The most difficult transformation any trader must undergo is the surrender of ego when confronting market reality. We all come to the markets with opinions, theories, and carefully constructed narratives about what should happen next. Maybe you've done fundamental analysis showing a stock is undervalued at $42, so clearly it should break out and rally. Or perhaps your technical indicators suggest the range is too tight and compression will lead to explosive movement. These opinions feel so logical, so well-reasoned, that we start treating them as facts rather than what they actually are, just educated guesses about an inherently uncertain future. The hidden truth that changes everything is recognizing that the market doesn't care about your opinion. It doesn't matter how much research you've done or how confident you feel about your analysis. When price action clearly shows a stock respecting its boundaries, bouncing predictably between support and resistance, the market is telling you to trade the range. When it shows a decisive breakout with conviction, the market is telling you the range is over. Your job isn't to argue with these signals or to impose your preconceived notions onto price action. Your job is simply to adapt and respond to what's actually happening right in front of you. This journey into humility represents one of the most profound psychological shifts you'll make as a trader. Behind the scenes of every blown account is someone who fought the market because it wasn't behaving according to their expectations. They saw a stock breaking below support and thought, "This is wrong, it's oversold, I'm going to buy more and average down because I know it will bounce back." Sometimes they're right and the ego gets reinforced, but eventually the market teaches its harshest lesson to those who refuse to accept reality. It takes everything. Think about how this dynamic shows up in your own trading decisions. How many times have you watched a clear signal unfold, but dismissed it because it contradicted your narrative? The stock breaks support, but you hold on because you believe in the range. Or it consolidates beautifully, but you refuse to trade it because you're convinced a breakout is imminent. In both cases, you're prioritizing your opinion over observable reality, and the market has no patience for this kind of stubbornness. This is where proper risk management through stop losses becomes not just a technical requirement, but a psychological safeguard against your own ego. In sideways markets, your stop-loss placement is beautifully straightforward, just outside the range boundaries. If you're buying at support near $42, your stop goes just below, maybe at $41.50. This isn't arbitrary. You're essentially telling the market, I'm trading this range, but if the range breaks, I accept that conditions have changed and I need to exit immediately. The impact of this simple rule cannot be overstated. That small loss you take when support breaks, maybe 1 or 2% of your position, is your insurance premium against the devastating losses that come from refusing to accept when you're wrong. The trader who won't take that small hit, who holds on hoping the stock will magically return to the range, often watches in horror as the breakdown accelerates and what should have been a manageable loss becomes a catastrophic one. Now, I want to go even deeper into understanding how accepting these small, defined losses actually creates the psychological freedom that allows you to trade with confidence and consistency over the long term. If you've struggled with ego getting in the way of executing your stops, type "humility protects me" in the comments. One of the most satisfying aspects of mastering sideways markets is discovering that your win rate naturally improves compared to other trading strategies. And this positive feedback loop creates tremendous psychological momentum. When you're trading clearly defined ranges, you're operating within boundaries that have proven themselves multiple times. That support level at 42 has held 4 times already. That resistance at 48 has rejected price repeatedly. These aren't theoretical levels. They're battle-tested zones where real buying and selling pressure has consistently emerged. This predictability translates directly into a higher percentage of winning trades. The transformation in your trading confidence that comes from stringing together multiple successful trades cannot be underestimated. Think about how different your mindset becomes when you're winning 60 or 70% of your range trades versus the emotional roller coaster of trend-following strategies where you might be right only 30 or 40% of the time. That consistent positive reinforcement changes your entire relationship with risk-taking. You start trusting your analysis more. You execute with greater conviction. The fear that paralyzes many traders begins to dissolve because you're seeing tangible evidence that your approach works. But here's where the journey gets interesting and where most traders sabotage their own success despite having a winning strategy. Behind the scenes of every range trader who eventually blows up is the same fatal mistake. They get so comfortable with their high win rate inside the range that they forget ranges don't last forever. When that inevitable breakout happens and support finally gives way or resistance gets obliterated, they're caught completely off guard. That string of small profitable trades gets wiped out by one massive loss because they either didn't have stops in place or they ignored them, convinced the range would magically reassert itself. This is the hidden truth about sustainable success in sideways markets. Your frequent small victories must be protected by ironclad risk management. The mathematics only work if you let your wins accumulate while keeping your losses strictly contained. One uncontrolled loss from a range breakdown can erase 10 successful range trades. This isn't about being pessimistic or fearful. It's about respecting the reality that market conditions change, often suddenly, and your job is to adapt instantly. Rather than hope reality will bend to your preferences. The revelation that completes this puzzle is understanding that you don't need to trade every single oscillation within the range to be wildly successful. In fact, trying to catch every move is usually counterproductive. The amateur sees a stock bouncing between 42 and 48 and thinks they need to be constantly active, entering and exiting multiple times as it makes each journey across the range. The professional recognizes that quality absolutely trumps quantity. They focus exclusively on the highest probability setups, buying as close to support as possible with a tight stop underneath, or selling near resistance with similarly defined risk. This mindset shift from action to strategic inaction represents one of the most challenging aspects of the journey. We're conditioned to believe that more effort equals better results, that staying busy means we're being productive. But in range trading, your hardest work often happens when you're doing nothing at all. When price is sitting at $45 in the middle of your 42 to 48 range, the disciplined trader simply watches and waits. There's no edge there. The risk-reward is unfavorable. The optimal move is patience, and that patience is actually the most active decision you can make because you're actively choosing not to act, despite every impulse screaming at you to do something. Now, I want to go even deeper into recognizing the subtle price action signals that tell you when a range is healthy and tradable versus when it's beginning to deteriorate and preparing for a breakout. If focusing on quality over quantity resonates with your trading journey, write "less is more" in the comments. One of the most liberating revelations you'll experience in your trading journey is understanding that price action tells you everything you need to know long before any news article explains why. Think about what typically happens when a stock approaches resistance in a well-established range. Sometimes it pushes right up to that $48 level and bounces cleanly off it, just like it has multiple times before. But other times, something subtle changes. Maybe it approaches $47.50 and starts showing weakness, sellers stepping in earlier than usual, volume drying up on the upward push, or the bounce lacking the same conviction you've seen previously. These whispers from the market are occurring in real time, and the traders who act on these price signals are already positioned before any headline drops or analyst report gets published explaining the rejection. Behind the scenes of every major move is this sequence. Price acts first, narrative follows later. By the time CNBC is discussing why the stock failed at resistance or why support held firm, the informed traders have already executed their positions and captured the easy part of the move. The amateur trader, meanwhile, is waiting for confirmation, waiting for someone to explain why, and by then the opportunity has already been substantially depleted. This transformation in how you process information represents a fundamental shift from being a reactive trader to a proactive one. You're no longer dependent on external validation or expert opinions to take action. You're reading the market's own language, price and volume, and responding to its messages directly. The hidden truth is that the most reliable information doesn't come from research reports or earnings calls. It comes from observing how buyers and sellers actually behave at critical levels, and that behavior is written in the price action for anyone willing to see it. But here's what ultimately determines whether you succeed or fail in mastering sideways markets, and it has nothing to do with intelligence, education, or analytical sophistication. The market doesn't reward the smartest person in the room. It rewards the most disciplined. You can identify the most perfect range setup imaginable, textbook support and resistance, clean bounces, ideal risk-reward ratios, but if you lack the discipline to actually execute your trades at those precise levels, to take your profits near resistance, and to cut your losses immediately when support breaks, your edge evaporates completely. Think about the impact of this realization on how you approach your trading development. Most traders spend 95% of their time trying to find better indicators, learn more complex patterns, or discover some secret analysis technique that will give them an edge. But the real edge isn't in the complexity of your analysis. It's in the simplicity of your execution and the consistency of your discipline. The journey from struggling trader to profitable trader is almost never about learning something new. It's about actually doing what you already know you should do. Behind the scenes of every consistently profitable range trader is someone who has mastered themselves first and the market second. They've conquered the impulse to chase moves in the middle of the range. They've developed the patience to wait for optimal entries. They've built the emotional resilience to take small losses without hesitation when their stops are hit. These aren't technical skills, they're character traits, and developing them requires the same dedication you'd apply to mastering any difficult discipline. Now, I want to go even deeper into understanding how you can practically build these habits of discipline and self-mastery so they become automatic rather than requiring constant willpower and mental effort every single time you face a trading decision. If you recognize that self-mastery is your true edge in the markets, comment "I master myself" first below. If you've made it this far, I want to personally thank you for investing this time in understanding what truly separates successful range traders from those who struggle. This isn't just another trading technique. It's a complete mindset transformation about how you approach markets, discipline, and ultimately yourself. The principles we've explored today have the power to fundamentally change your relationship with trading if you're willing to do the inner work alongside the market analysis. I create content like this because I believe the trading community deserves depth and substance over quick tips and empty promises. If this resonated with you, and you want to continue developing these psychological and strategic skills, hit that subscribe button so you don't miss future videos where we go even deeper into the mental game of trading. This channel is for traders who understand that mastery is a journey, not a destination. And I'd love to have you along for it. Drop a comment right now saying "Range Mastery Unlocked" so I know you made it all the way through and absorbed these concepts. I read every comment, and it genuinely helps me understand what's connecting with you so I can create even more valuable content moving forward. And if you found this perspective helpful, a simple like goes a long way. Not for algorithm points, but because it helps other traders who need to hear this message discover it too. There's a video right here that takes these psychological principles even further and shows you how to identify the highest probability setups within any market condition, not just ranges. Click and continue with me over there as we build on everything you've learned today and translate it into practical strategies you can implement immediately. The journey doesn't end here. It's just getting started.